right, everybody. How are you doing? And let's get started on this one. I'm going to try to keep this one relatively short, but who knows? It is a part of economics that is really, really important. So we want to talk about it, and it is called monetary policy. Monetary policy, really, really important stuff. It's really important for a number of reasons. But the one thing that I do want you to take away from this, if you take nothing else away from this lecture, it is the importance of monetary policy. And the reason why I'm saying this is, especially this year, we're coming up on an election year, and you guys are going to have many election years. And one of the things that that politicians always run on is the economy. The economy, and if the economy is doing well, then the incumbent politicians, especially the president, they want to take credit for all of this, right? And then obviously, if the economy is not doing well, then the president doesn't want to take credit, wants to put, the blame somewhere else. But the party challenging him wants to blame the president for the economy, for what's going on in the economy. And here's the deal. Under normal circumstances, the president has very, very little control over what happens in the economy overall. I mean, let's face it, if the president had any control over what was going on in the economy, then unless the president was profoundly incompetent and all of the people that he hired were profoundly incompetent, the economy would usually do pretty well because no president would want to have a bad economy, right? But that's not the case, right? So under normal circumstances, a president or a sitting government has relatively little control over whether the economy is doing well or whether the economy is doing badly. Now, the president and the government has control over what they do about it. They have control over how they handle an economy that is bad or what they do when the economy is good. Those things you can kind of parse, but to just kind of say, hey, the economy's doing well, let's reelect the president, or the economy's doing well, let's reelect our representatives, not a particularly good decision. Or the economy's doing badly, let's get this president out and get a new president in. That may not necessarily be your best option. You really want to take a look at policies. But anyway, let's talk a little bit about what I mean by monetary policy. Monetary policy is the decisions made by central banks. All right? And what you're going to find, and the thesis of this video is that under normal circumstances, there are going to be some exceptions I'm going to talk about at the end of this video, but under normal circumstances, central banks and the decisions being made by central banks is what regulates the economy. All right? Now, that's not to say, again, if central banks had made all of the decisions, then what they would do, then the economy would be doing pretty well. The central bankers are pretty competent folks. There are external circumstances that move the economy one way or the other, but under normal circumstances, it's central banks that figure out how to deal with these rises and falls in the economy, right? All right, so monetary policy, the decisions of central banks. In the United States, that central bank is the Federal Reserve, otherwise known as the Fed. Now, this is one of those areas where if you decide to Google or go on YouTube and Google Federal Reserve, almost all of what you're going to get is just absolute crap, because the Federal Reserve, being a central bank, relatively new central bank, is subject of a lot of conspiracy theories and fear-mongering, and, there's much of what's out there about the Federal Reserve is real garbage. Really, the Federal Reserve is just a big banking conglomerate that has a job given to it by the government, right? The Federal Reserve is a private bank, but it serves a government function, right? It is chartered by the government to serve as the U.S. central bank. Is that a perfect arrangement? No. Are there inconsistencies and inequalities? Sure. Can you find instances of corruption? Yeah, absolutely. But for the most part, the Federal Reserve is just a boring bureaucracy that has a particular job. And in this case, now there's a couple jobs that the Federal Reserve does. I will I'll post the notes, and it'll show you the structure of the bank and how it's set up and that kind of thing. You can search that out. But for the most part, for the purposes of this video, I want to just talk a little bit about the Federal Reserve and what it does with regard to monetary policy. Now, a couple of the things, some of the more bureaucratic things that the Federal Reserve does. The Federal Reserve, one of its primary jobs is to print money. All right, it actually the Federal Reserve. If you take a look at a dollar bill, you will see right on the top of the dollar bill, it'll say Federal Reserve note. All right, the Federal Reserve prints the money. And believe it or not, the Federal Reserve is also responsible for destroying money. So every bank, when you go to the bank and you turn in money, if that money is all tore up and crinkled and it's just no good anymore, the bank literally puts it in a big bag and ships it to the Federal Reserve, and the Federal Reserve takes note of it and then destroys the money. Actually, takes note of the number on the money. Every bill has a number associated with it, and they actually track that and they destroy that money. Believe it or not, they burn it. So that's pretty cool. So the Federal Reserve is responsible for basically regulating how much money is in the market. So remember, if you watched the video on the gold standard, you saw we talked about monetary base. Well, that's pretty much the job of the Federal Reserve, is regulating that monetary base, right? Just making sure that there's X amount of dollars in the market at any given time, making sure that monetary base expands in such a way that it is able to accommodate the needs of the population without expanding too fast and creating inflation. The Federal Reserve also is responsible for maintaining payment systems like credit cards, debit cards, online checking, all of that other kind of stuff. They regulate that kind of thing. They also are responsible, if you are a member bank of the Federal Reserve, and most banks in the United States are members of the Federal Reserve in some way, they regulate those member banks. They provide financial literacy, links and education opportunities. And one of the biggest things that the Federal Reserve does is the Federal Reserve basically acts as the government's bank. All right, so if the government needs to borrow money, the first place it goes is the Federal Reserve. Right? So many of you are wondering, well, how does a government go into debt? And we'll talk about that when we talk about fiscal policy. Well, what they do is they sell treasury bonds to the Federal Reserve. And so the Federal Reserve kind of acts as the government's bank. So these are some of the responsibilities of the Federal Reserve. But the most important thing, the main mission of the Federal Reserve is what we call a dual mandate. All right? The Federal Reserve has two primary jobs. And these jobs kind of tie in, go hand in hand together. So the primary job of the Federal Reserve is, one, to keep a high employment rate. We want as many people in the country working as is possible. So it's the job of the Federal Reserve to, if they see the employment rate starting to drop, they're expected to do something about that, right? So keep employment high, all right? And at the same time, they're also expected to keep inflation low. Now, this is not as easy as it sounds, right? Because here's the deal. When everybody's working, right, when you have high employment, what happens is everybody's getting paid. That means that you're expanding the monetary base, right? That monetary base is expanding. The amount of money in the economy is expanding. So, well, what that tends to do is that tends to increase inflation, right? Because the more money you have in the economy, the higher the easier the money is to get, which means that the money loses value. All right, so you have inflation caused by an excess amount of money in the monetary base. So, what the Federal Reserve has to do is the Federal Reserve has to figure out how to maintain a balance between high employment and low inflation, relatively low inflation. We want some inflation, but we don't want too much inflation. So how does the Federal Reserve balance that, right? And that's the trick that the Federal Reserve has to figure out, maintain that balance. High employment, you don't necessarily want 0% unemployment or 100% employment. Not everybody's going to be working at any given time, right? But you want to get it as high as you possibly can, while at the meantime maintaining relatively low, I think the target inflation rate for the Federal Reserve right now is about 2%. That's what the Federal Reserve wants to see. Some economists think it should be a little bit higher, but right now the target is 2%. So this is the dual mandate of the Federal Reserve: maintaining high employment, low inflation. So how does the Federal Reserve do that? Okay, so how does the Federal Reserve do this? How does the Federal Reserve maintain this balance between employment and inflation, right? Again, it's tricky. As employment increases, there's the tendency for inflation to increase, right? So that means that any attempt to lower inflation may increase unemployment, right? At the same time, if unemployment is high, you want to get that unemployment down, but anything that you do to decrease unemployment is probably going to increase inflation, right? So it's a real serious, interesting balancing act, and quite frankly, over the years, the Federal Reserve has gotten relatively good at it. And we can tell that because the space between economic recessions is largely widened, and economic recessions have typically not been as bad as they used to be before the Federal Reserve. You can go and research that on your own to confirm that, right? So now there's a couple of strategies that the bank is going to use, that the Federal Reserve is going to use at its disposal to try to maintain this balance. One of those is based on the concept of fractional reserve. Now we've touched on this a little bit when we talked about banking earlier in the semester. Fractional reserve basically means that when you put your money in the bank, when you make a deposit, when you put something in savings, right, the bank doesn't just sit on that money. The bank loans that money out, right? So the bank only keeps as much money as it thinks it's going to actually need in day-to-day transactions. The rest of that money they largely loan out to people, right? So basically, if you deposit $1,000 in the bank is going to take a percentage of that $1,000 and is going to loan it out, right? Well, the Federal Reserve basically gets to tell member banks how much of that deposit they're allowed to loan out, right? So think about that. Think about the consequences of that. So let's say if you deposit $1,000 in the bank, and that bank can then just loan out $1,000, they don't have to have that $1,000 in reserve. All of that $1,000 they can just put out into the monetary base. They can loan that out, right? So what the Federal Reserve does is the Federal Reserve says, whoa, wait a minute, member banks, you have to keep a certain amount of that deposit in your bank. You're not allowed to loan it out, right? So let's say the Federal Reserve says, okay, you have to keep 10% of any money that you get in. You have to keep 10% of that on hand at any given time. So what that does is that limits or defines how much money banks can loan out, right? So think about this. Think about what this means conceptually, right? Let's say you have a period of relatively high inflation. Inflation is too high, and the bank wants to reduce that inflation. One of the things that it can do is it can increase the reserve requirements. Can say, hey, banks, you have to hold on to more money, right? Well, what that means is that means the bank is limited in how many loans it can make, right? It's going to charge higher interest on those loans. It's going to, have higher standards for who it gives the loans to, because now it has to hold in reserve a larger amount of money. And by doing that, that kind of helps to reduce and lower inflation, because it limits how much money goes into the monetary base and is in circulation. Now, what about during periods of high unemployment, right? If you want to increase employment, what you can do is tell the member banks that they're allowed to loan out more money. Hey, member banks, we're going to reduce the reserve requirement. We're going to lower the amount that you have to keep in reserve. Maybe we'll lower it, it's at 10%, maybe we'll lower it to 5%. This gives the bank the opportunity to loan out more money, right? And who are they going to loan that money to? Well, they're going to loan that money to businesses that want to invest in the business. They may want to loan that money to people buying houses and buying property, right? And what does that do? Well, businesses can then take that money and they can hire people, or maybe you're buying a house. That means that you're going to hire people to come in and refurbish and build and all this other kind of stuff. So that the idea then is that by allowing these loans to go out, you're increasing the probability that that money is going to be spent on employment and increase employment. So that maintaining this reserve requirement, it's a very powerful tool that the Federal Reserve has at its disposal to kind of regulate inflation. So remember, increasing the reserve requirement, lowers inflation. If you're not worried about inflation, you can decrease the reserve requirement, and that will increase employment, right? That's the goal. It'll increase employment, right? Now, another strategy that the Federal Reserve has at its disposal is called the discount rate. And the discount rate is basically, one of the things that the Federal Reserve does is the Federal Reserve loans money to its member banks, all right? Where does the bank get the bank that you do business with, where does it get the money that it needs? Well, it borrows that money from the Federal Reserve, right? The Federal Reserve is a banker's bank. You can't go to the Federal Reserve and open an account, right? If you own a bank and you join the Federal Reserve, then you can, right? So the discount rate is the interest that the Federal Reserve charges member banks to borrow money from the Federal Reserve. Well, that means, think about what that means, right? Think about the consequences of that. If the Federal Reserve raises its discount rate, it raises the interest rate that it charges to member banks, that means that the member banks, when they loan that money out, they have to loan that money out at a higher rate than the Federal Reserve charges them for the money, because otherwise they can't make any money. They can't. Falcor is a big fan of the Federal Reserve. That's a good girl. Yes, I know. That's a good girl. So, think about what this means as far as monetary policy is concerned. Well, what this means is that if the banks want to lower inflation, what they can do is they can increase the discount rate. They can increase the rate that they charge their member banks, right? And that is what we refer to as tight money policy. When the bank raises the discount rate, that means that your bank then has to charge higher interest to give you a loan, which means you're less likely to take the loan. You don't want to have to pay that interest, right? So, okay, I'll wait. I don't need the loan right now, and that means that you're not going to expand your business. You're not going to build a house. You're not going to do those things. So it gets money out of the monetary base. Now, if the Federal Reserve wants to increase employment, what they do is they decrease the discount rate. In other words, what they do is they lower the interest rate. That gives the bank that gives your bank the right to decrease their interest rates, and that incentivizes you to take out that loan. Right? Oh, well, my interest rates are going to be relatively low. I'll take out the loan. I'll buy that house. I'll expand my business. Right? And that's called easy money or loose money policy. So decreasing the discount rate, it should increase employment. Increasing the discount rate should lower inflation. And this is how. And what they'll do is they literally, the Board of Governors, and they get together and they decide, well, wait a minute, what's this? What is the policy that we need to make? What exactly are the numbers? And they have economic bean counters, going through the numbers and coming up with the optimal balance between the reserve requirement and the discount rate for maintaining the economy. Now, a couple of things that the Federal, a couple of other things that the Federal Reserve can do is they can do what's called open market operations. In other words, the Federal Reserve can go out and they can purchase securities like bonds and treasuries and stuff like that. And when they purchase those bonds, they purchase those securities, they increase the value of those securities, and that's a way of regulating the market in that way. And then another way is a fairly new strategy that came out during the recession, and I'll explain why in just a moment, called quantitative easing. In other words, one of the benefits that the Federal Reserve has as a bank, as a company, again, the Federal Reserve is a private bank, but it's a very special private bank. It serves a government function. Therefore, the Federal Reserve can't go bankrupt. No matter what happens, the Federal Reserve can't go bankrupt. If the Federal Reserve is going to go bankrupt, they'll just print more money and they'll not go bankrupt, right? They have that power to do that. So one of the benefits of that is back in 2008, 2009, when all of these banks started to go bankrupt because they had made bad investments, the Federal Reserve can't go bankrupt. So what the Federal Reserve did is they bought all of those bad investments. They bought up all of that crappy, speculative derivatives and stuff like that. They bought all of those up to get them off of the market, and they basically ate it. because they can't go bankrupt, and therefore it's not a problem for them. So that was known as quantitative easing. It's a relatively new strategy that the bank has. All right, so under normal circumstances, this works pretty well. Right? Under normal circumstances, this works pretty well. But sometimes we're not facing normal circumstances. So the next thing I want to talk about is what can go wrong. What can go wrong? And we're going to talk about that in just a moment. Voila, it's like magic. So, all right, so what can go wrong? Like I said, under normal circumstances, the Federal Reserve, they do a pretty good job of maintaining that balance between maintaining high employment and maintaining low inflation, relatively low inflation. They find that balance. But what could possibly go wrong? Well, there are a couple instances where monetary policy just didn't cut it. Now, under normal circumstances, we let the central banks run the economy. We let them respond to the rising and falling of the economy and get things back on track, right? So during times of recessionary periods, we can see the Federal Reserve lowers loosens the monetary policy, more money gets into the market, and the economy comes back. But there are times when this gets a little bit tricky. So one of those times is a period in time that we experienced back in the 1970s, and that was a period known as stagflation, right? Stagflation. And this was a real problematic period because what we were experiencing in the 1970s, I'll show you the chart right here. What we were experiencing in the 1970s is a period in which both unemployment and inflation were high, right? Well, now what do, right? If you have both high unemployment and high inflation, now there's a whole bunch of reasons why this happened. I'm not going to get into the weeds of it. You can look it up if you want. But suffice it to say that the economy at that period of time experienced this stagflation, right? We had both high inflation and we had high unemployment. Now what do? Now what does the bank do? Because now if the bank decreases its reserve requirements, right, and it loosens up the monetary base, right, and it decreases its discount rate, well, then what's going to end up happening is inflation's going to shoot through the roof. Well, you don't want that, right? But at the same time, if you tighten the monetary policy, right, and you increase the reserve requirement and you increase the discount rate, well, then unemployment is going to shoot through the roof. And oh my God, you don't want that either, right? So now what do? And the 1970s was just this negotiation of suckitude as far as the economy was concerned. And ultimately, what the Federal Reserve decided to do at that point is they decided that the most important thing that they could do, they decided that inflation was easier to deal with than unemployment. And that once they got inflation under control, they could then go back and they could then deal with unemployment. Now, of course, who wants to be the president? That is, the president when the Federal Reserve says, you know what, we're just going to tank it and start from scratch by raising the discount rates and raising the reserve requirements. Unemployment shoots through the roof, right? Who wants to be the president during that period? Well, it turned out nobody wants to be the president during that period, and ultimately the Federal Reserve had to make the decision. We elected a new president. He was fairly popular. The Federal Reserve decided that they could get the economy back under control relatively quickly. So early in the presidency of Ronald Reagan, the Federal Reserve jacked up the discount rates and they jacked up the reserve requirements, and basically the Federal Reserve created the deep recession of the early 1980s. Now, of course, Democrats jumped on this and blamed Ronald Reagan for the terrible economy, and they went on the stump, and it had nothing to do with Ronald Reagan's policies. It all had to do with the Federal Reserve, and they tanked the economy intentionally. And it worked. What ended up happening is relatively quickly, the inflation came down, and once the inflation got to the point where the Federal Reserve felt pretty comfortable with it, they then loosened the monetary policy. They then increased the amount of money. They lowered their discount rates. They lowered their reserve requirements. They got more money into circulation, and the economy came back. And of course, the Republicans, jumped on this and gave Ronald Reagan and they continue to give Ronald Reagan all the credit for the economy coming back during that time. It, again, had nothing to do with Ronald Reagan's policies. It had to do with the actions of the Federal Reserve. But it did work, but it was a very, very profound period of extreme, I was about 12 years old at this time, so I remember my parents trying to get through this process. It was pretty extreme. It was one of our deepest recessions, but it was not a recession that lasted particularly long. Right, so that's how the Federal Reserve there was just no other way to do it as far as the Federal Reserve was concerned. Now, the next problem we have is the problem that we faced in 2008 with what we call the Great Recession, right? And this was a problem called a liquidity trap, right? So the backstory of this was in the 1990s we had an expanding economy. Much of that was because of the internet. The internet opened up a whole bunch of markets for us, right? And all kinds of economic opportunities for us, right? Again, Democrats like to give President Clinton credit for this great economy that existed in the 1990s. It has very relatively little to do with that. That had to do with the tech, investments in tech, right? But what did end up happening was in 2000, 2001, what we call the tech bubble burst, and it created a relatively minor recession that the Federal Reserve dealt with just like it normally does with recessions. It lowered the reserve requirements and it lowered the interest rates, and that got the economy growing again. We grew relatively slowly, but it did start to grow until about 2008. And what happened in 2008 is the speculative bubble that we had to do with derivatives. We talked about that before. That collapsed. All these investments, these really fancy schmancy investments that finance banks were making, they all fell apart, right? And this created the recession in 2008. But there was a problem. Is through the 2000s, the Federal Reserve didn't raise its rates very much. It kept its rates relatively low. And the reason for that is because the economy was growing relatively slowly. It didn't bounce back like it did in the 1980s. So the Federal Reserve kept their rates relatively low. But the problem is that when the 2008 recession hit, it was a deep, deep recession that required the bank to lower its discount rates and lower its reserve requirements more than it could, right? No bank is going to loan at less than 0% interest, right? So banks are stuck at what we call a zero lower bound. The Federal Reserve is not going to loan money to banks at negative 2% interest. Although, technically, I guess they can, but they're not going to, right? That's the zero lower bound. So consequently, the Federal Reserve was not able to lower rates enough to actually turn the recession around. It's a period of time called a liquidity trap. Nobody wants to borrow money. There was already a lot of outstanding debt in the market. There was already, and there were very, very few actual investment opportunities. Nobody wants to borrow, right? Housing is a big part of borrowing, but housing prices were collapsing. Nobody wants to take out a mortgage. So no matter how low the Federal Reserve lowered its interest rates, nobody was borrowing money, right? In other words, they wanted liquidity. They didn't want debt. They wanted actual money on hand that they could get access to, right? You could not get anybody to borrow money during this time period. It was called a liquidity trap. And that means that there's no real way for central banks to expand the monetary base during a recession if people aren't going to borrow. So that is called a liquidity trap. And in this case, the Federal Reserve was pretty much stuck. Standard monetary policy just doesn't work. Now, what they do is they did some quantitative easing and buying some bonds and stuff like that to get that kind of investment going. But at this point, there was very, very little that the Federal Reserve could do. And when that happens, then what we're stuck with fiscal policy, right? Now we have to deal with government policy that's going to get the economy back online. And that will be the topic of the next video. In the meantime, if you have any questions, please contact me, Zoom, the whole 9 yards. I'll bet you that.